Have you ever asked yourself a simple question? Every country on earth owes money. Rich nations, poor nations, allies, enemies, every single government is in debt. That fact alone should feel impossible, because debt implies a creditor. Someone who is owed, someone who holds the surplus. But if everyone is a debtor, who is the creditor? This is usually where the story ends in textbooks. But tonight, we go where those explanations stop into the hidden architecture of global debt. Because what you're about to see isn't chaos. It isn't incompetence. And it definitely isn't an accident. It's a system layered, engineered, and designed to reinforce itself. And once you see the structure, you can't unsee it. For most of human history, debt was a pretty straightforward concept. One person borrowed, another lent. One kingdom lost a war, the other demanded tribute. Debt had a clear beginning and a clear end. Empires defaulted on their obligations. Kings were overthrown for bankrupting their nations. Debts were often forgiven through conquest, collapse, or simple cancellation. There was no permanent, global balance sheet keeping score. But everything changed when money stopped being a thing and became a promise. That transition didn't happen overnight. It happened quietly through institutions, banks, central banks, international agreements, and most importantly, through standardization. The modern architecture of global debt really begins in 17th century Europe. Governments stumbled upon a revolutionary discovery. They didn't actually need to repay their debt. They just needed to service it, pay the interest. England pioneered this with something called perpetual bonds. Instead of paying back the principal loan, the state promised to pay interest forever. Suddenly, debt became permanent. Then came the next major innovation: central banking. The Bank of England wasn't created to help citizens or businesses. It was created to help the state borrow money on a massive scale. Private capital could now fund public debt, all backed by the government's power to tax its people and wage war. This was the birth of sovereign debt markets. For the first time, governments could expand their ambitions endlessly, as long as confidence in their ability to pay interest remained. Debt stopped being a liability. It became infrastructure. Now, let's fast forward to the 20th century. 2 world wars had shattered economies and erased gold reserves. Nations needed rebuilding, and they needed a coordinated way to do it. So, in 1944, delegates from around the world met at Bretton Woods, New Hampshire. Out of that single meeting came 3 powerful institutions: the International Monetary Fund, the World Bank, and a global financial system anchored by the US dollar, which itself was supposedly backed by gold. This was sold to the world as a new era of stability. But what it quietly did was centralize the architecture of global debt. The US dollar became the world's primary settlement currency. International trade, oil sales, foreign reserves, everything started flowing through this one system. Countries no longer borrowed only in their own currencies. They began borrowing in dollars. And that changed everything. Because if you don't control the currency you borrow in, you don't control your debt. By the 1960s, cracks began to appear in this new system. The United States was running huge deficits to fund the Vietnam War and its ambitious social programs. This meant a flood of US dollars was pouring out into the world. Foreign governments, holding mountains of these dollars, started asking a very dangerous question. Is there actually enough gold in America, asphalts, to back all of this paper? The answer was no, not even close. So, in 1971, President Nixon made a stunning announcement. The US was ending the dollar's convertibility to gold. The anchor was cut. The dollar became pure fiat money backed by nothing but faith in the US government. This was the moment global debt escaped all physical limits. Currencies floated freely against each other. Credit became elastic. From that point on, there was no natural break on the creation of debt. Global debt didn't just grow, it began to compound exponentially. Today, we call countries sovereign nations. But sovereignty without monetary control is largely an illusion. Many nations are forced to borrow in foreign currencies like the dollar or the euro. Their economic health depends on the whims of international capital markets. And often, they must obey strict conditions attached to the loans they receive. When a crisis hits, the true nature of this architecture reveals itself. Bailouts from institutions like the IMF come with demands for austerity. Financial assistance comes with requirements for restructuring the entire economy. Stability comes with oversight from external powers. The IMF doesn't enforce debt with armies. The market does it for them. Ratings agencies like Moody's or S&P can decide a country's borrowing costs with a single downgrade. Central banks like the Federal Reserve decide who gets liquidity. And the nations that control the world's reserve currencies ultimately decide who survives a crisis. Debt becomes leverage. Not through force, but through structure. Every generation, new solutions are proposed to fix this mess. Debt forgiveness for poor nations. Creating a new global reserve currency. The rise of digital money. Monetary unions like the Eurozone. But each of these fixes carefully avoids the core issue. The system itself requires three things to survive: continuous borrowing, continuous economic growth, and continuous confidence. Without a constant flow of new debt, modern economies contract. Without growth, the existing mountain of debt implodes under its own weight. And without confidence, the currencies that hold it all together fail. So, reforms always circle the problem, but never go through it, because collapsing the architecture of debt would mean collapsing everything that has been built on top of it for the last 300 years. Today, the pattern is just accelerating. Global debt now exceeds global GDP by multiples. Governments don't repay their debt anymore. They just roll it over, borrowing new money to pay off old loans. Central banks have become the biggest buyers of their own government's bonds, creating money out of thin air to stabilize markets. Debt no longer just funds the future. It's desperately needed to maintain the present. And every crisis, from the 2008 financial meltdown to the recent pandemic, demands even more debt to solve it. The pandemic didn't create this problem, just pulled back the curtain and exposed it. Debt is no longer a tool. It is the foundation. So, we come back to our original question. If everyone is a debtor, who is the creditor? The answer is as unsettling as it is simple. There is no single person or entity. The creditor is the system itself. A self-referencing, self-perpetuating structure where debt creates money. That money is used to service older debt, and real-world control flows through the institutions that manage this cycle, not through individuals. Let's break this down into three key takeaways. First, global debt is permanent by design. Repayment was never the goal, servicing it was. Second, true sovereignty depends on currency control. Without it, debt becomes a tool of dependency. And third, crises don't break this system, they strengthen it. Each one centralizes power further into the hands of those who manage the architecture. The warning here is simple. When a system requires endless debt just to survive, collapse isn't a possibility, it's just a question of timing. And the final, terrifying question remains: what happens when confidence, the only thing holding it all together, finally runs out? If this changed how you see debt, money, or power, subscribe to the channel. Because our next story isn't about how much debt exists. It's about what happens when the architecture finally demands payment. Thanks for watching.